more electronic basis, we see this type of skill set starting to disappear, especially amongst retail traders. And retail traders are the ones that can benefit the most from this. So, this is something that we focus a lot of our time on, and it's actually something that we take a lot of our trades based on. I would say 85 to 90% of all the trades that I take and all of the trades that Andrew take are based on something that we have seen in unusual option activity order flow. And just so all of you guys know here, at the end of this, we are going to have a bonus offer at the end of the webinar. So stick around for that. And we're going to go ahead and get started here. So first I want to talk about of order flow. Now there's some terminology, and in options, terminology does often trip people up. So I always like to explain it. Paper. We talk about paper. What is paper? Now, paper is a big order from a mutual fund, hedge fund, investment bank, big trader, institutional order flow. The term paper is a holdover from the days of the trading floor, and orders would come in on physical pieces of paper, physical cards, and they would trade that way. So that's kind of a holdover from there. That's where we get the term paper. A lot of people get confused when they hear us use the word paper and think that we're talking about a SIM account or a paper money account. That's not what we're talking about. We're talking about big institutional order flow. The second key point here is who trades options. Who are the players in the equity options space? Obviously we have two main groups here, hedgers and speculators. Who are the hedgers? The hedgers are mutual funds, hedge funds, who are using the equity options market to hedge their underlying stock position. Right, and this is kind of the end goal of reading order flow, is to figure out what that underlying stock position is. We also talk about why paper is important. Why do we want to know what big hedge funds are doing in the market? Why is that important to us? And there's actually a couple of reasons. One of the main reasons is that their capital and technology gives them access to information that regular retail traders might not have. Think about how much time and effort goes into a trading idea turning into an actionable trade at a hedge fund. It might go through dozens of analysts. They have technology that I simply don't have access to, and they do have information that I do not have access to. So they have a size advantage, an informational advantage, and a technical advantage that I can then take advantage of if I know how to read order flow. Basically, it lets me profit off of all of their hard work and off of the information that they have access to that I don't. Okay, so there are four basic types of order flow: paper buying calls, paper selling calls, paper buying puts, and paper selling puts. Now, obviously, we can see orders hitting the tape in any combination of spreads and other strategies, but we like to pick out single big block trades in a single line. Those tend to be the most accurate. However, it sounds like an easy game, right? If someone's coming in and getting long a stock, it might be easy for me to jump in and try to mirror paper's trade there. If I see 10,000 out of the money calls of a stock being bought, it might be easy for me to say, wow, they're very bullish, that stock. I want to follow that. I want to get long this thing somehow. But we have to keep in mind that the majority of equity options market participants are hedgers, right? So when paper comes in to buy calls, what does that mean? It either means, one, they're getting long the stock via those calls, or two, they're using those calls to hedge an existing short stock position, right? So it's my job to try and figure out which one of those is the case, right? I don't want to be getting long a stock just because paper is buying calls, because they could be short the stock. It can be an incredibly bearish looking signal. And we say that about 70% of the time it is actually a bullish signal, and 30% of the time it is bearish. Now, paper selling calls, again, on the nose, that looks like a bearish looking trade. However, we have to keep in mind that a very popular trade in equity options is the covered call or the buy right, creating an extra dividend stream against a long stock position. So we say that 50% of the time that is actually a bearish signal, but 50% of the time it is a bullish signal. Paper buying puts, again, can be speculation on bearish movement, or it can be a hedge against a long stock position. We're going to talk about, how we go about trying to figure out what that underlying stock position is, if there is one. And then finally, we get to our holy grail of unusual option activity, paper selling puts. Now, we would say that 80% of the time, when paper sells puts, they do not have an underlying stock position. It is very rare that they have some kind of underlying stock position when they come in and sell a huge block of puts. Now, the reason for that is, one, that trade is known as a short right, where they're short the stock and sell puts against to try and create a bit of a dividend stream from a short stock position. And that's not very common. That doesn't happen very often. So we say that 80% of the time, that's a screamingly bullish looking indicator when paper is selling puts. So that is our favorite type of unusual option activity. Whenever I see big blocks of puts being sold, I get interested in the stock and I dig a little further. This isn't a magic bullet. There is no such thing in the market as something that works 100% of the time. The ticker tape doesn't lie, and I can never truly know what the stock position is behind that big order. But we have a method that we think works very well at trying to decipher what that underlying stock position is and trying to decipher what these orders are really telling me. So like we said, mutual funds, pension funds, sovereign wealth funds, these are all giant, massive players in the equity options market. And by being able to see what these whales are doing, we can see opportunities to profit or control our risk. I could have a position that I had already had established, a long position in a stock, and then I see paper coming in and getting incredibly bearish, or coming in and hedging at a time, ahead of an event. Then I could probably consider doing what they're doing as a hedge, or exiting my position if it really does look like they're betting on the stock to fall apart. It can also keep me out of trades that maybe I wouldn't want to be in. If I'm considering a long position in any given equity, and I see that the order flow in that equity in the options market has been incredibly bearish, I probably would no longer want to consider setting up a long position. And I talked about this a little bit earlier. It also helps us follow the smart money, right? We can see what the more aggressive money is doing. We call these the sharks. These are the hedge funds, the high frequency guys. And we can see opportunities to profit by following, smarter organizations. When I say smarter, I mean they do have better access to technology. They have dozens of analysts that work on, covers single stocks. And the information that they have and the knowledge that they'll have about those equities is always going to be greater just because they have better access to information. But once I see that trade hit the tape, that becomes public information. And if I can recognize that as a signal, I've essentially profited off of all of their hard work. Or I can get into a trade that they've worked very hard on arriving at an actionable idea. And that's why we want to follow order flow and look at what institutional paper is doing. So here we have an example of what this looks like on a intraday basis, right? So we have a proprietary scanner that scans every single equity options exchange, and there's a lot of them, and picks up all of the trades from all of those exchanges and displays them on a feed for me. And I sit here and I watch the tape, and I see these come across all day long. Thousands of these will come across in a single day. 2,000 trades will hit the tape in a day. Out of those 2,000, maybe 100 would be considered unusual, and maybe 5 or 10 actually would present actionable trade setups. So it does take a lot of screen time to get to the bottom of this, but it is definitely worth it. So this is an example of how we read this and what this looks like when it does hit the tape. This is LUX, a trade that came across in LUX. So here we have the different parts. It's labeled as a sweep, meaning that they took the whole position, all 10,000 of these, in a single trade and swept the exchanges to get them all. We see the timestamp. This can be important when we look back at unusual option activity and see if big trades in a given stock do a good job of leading moves in the stock. We had some unusual option activity in LNG, Cheniere Energy, earlier this week. I'm sorry, on Friday, and then on Friday we saw the stock rally over 4.5% immediately after a large block of out-of-the-money calls was bought, and then we saw more follow through on Monday. We look back at the timestamp and see that that trade did do a good job of leading the move in the stock. So when I see things like that, I know that, okay, that trade did a good job of leading LNG, the move in LNG. It's done that before in this year. LNG is a stock that trades well off of unusual option activity. Now I have LNG on my radar all the time. And I know that I always want to be looking at what the options action in LNG is like. This tells me whether these were bought or sold, how many, the stock, the expiration of the option, the strike price of the option, whether it was a call or a put, the price it traded at, and the implied vol at the time. Big block trades will have effects in implied volatility. So, it might be useful information for me to see, how much the implied vol has changed after a big block has traded. This also tells me the exchange where the trade happened and what the bid and the ask were at the time. So sometimes we'll see an order that comes across that doesn't trade exactly on the bid or exactly on the ask. We can see here that these puts were sold at 40 cents, and at the time, the market was 40.70, 40 bid at 70, okay? So I know that they sold these on the bid, so that's a more aggressive sell than if they sold these puts for 50 cents, say. Okay? It tells me that paper wanted to sell these 10,000 LUX puts, and they came in and they sold them on the market maker's bid. They didn't try to work it. They just took they took the 40 cents. Right? So that tells me it was more aggressive. Now, this is one of the most important parts of this order. Was it an opening or a closing position? Right? Now, all opening positions technically should be labeled as opening. That doesn't always happen. The broker could be in a rush. They forget to do it. It does happen. We do have a trick. If it's not labeled an opening position, I can look at the volume versus the open interest. So let's say this wasn't labeled an opening position. I would then pull up my options chain and go to the June 50 puts in LUX and look to see what the open interest was. At the time, and I remember this trade, this was 10,000 puts sold against basically zero open interest. So if the volume is greater than open interest, it is most likely an opening position. If volume is less than open interest, it is most likely a closing position. Now, some people say that I only want to be paying attention to opening positions, and that is true. When I'm looking to initiate a trade, I do only want to follow opening positions. But I also want to keep my eye on closing positions as a clue of when I might want to exit other positions that I have in the stock or exit a position that I took off of unusual option activity. And this is also key. This tells me where the stock was trading when the trade took place, right? It tells me, how aggressive were they when they sold these, right? The stock was at 50.40. They sold these puts for 40 cents with a decent amount of time left to go. This is a pretty strong line, right? They're taking a pretty strong bullish stance here. with the stock selling the at-the-money puts, right? Now, we have our scanner programmed to have special alerts when trades go across at a certain size that would be significant percentages of what it normally trades. And that is what we consider unusual option activity, right? 10,000 contracts traded in a lot of different stocks might not be a big trade. 10,000 lot in the SPY or the SPX or Bank of America or the VIX isn't even worth my attention. 10,000 lot is nothing. In a stock like how will open interest show up the next day after the puts were sold? Right. So the day that this trade took place, I see volume of 10,000 and open interest of nearly zero. The next day, open interest will be at 10,000. Yes. So like I said, we have our scanner program to show us this unusual option activity, right? There's thousands and thousands and thousands of trades that would hit the tape every day. And even with the filters that we have in place, there are still thousands that hit the tape. But it filters out all of the noise, what I call noise. And the noise is, big ETFs, big indices where 10,000 contracts, 15,000 contracts, 50,000 contracts is not a big trade. I don't want to follow those. Okay, so here is another example of a unusual option activity trade that we saw in Groupon. And this happened recently. This was last month, and this did turn out to be a profitable trade. So we saw some institutional player come in and buy 20,000 Groupon 8.5, 10.5 bull call spreads and sold the 8 puts against it for 30 cents. Now, this is an interesting trade for two reasons. One, it's a big size quantity, right? 20,000 of these call spreads were bought. And two, the short put leg is something that I definitely want to pay attention to as well. What does that mean? Right, they sold these puts to finance the purchase of the call spread, but the risk on short puts is incredibly high. Right, I'm risking leveraged losses underneath 8 here with this short put component. I know that this trader is risking $830 per one lot on a 20,000 lot trade. This tells me that their conviction here is rather high because they're risking $830 to make $170 on a $600,000 bet with a $600,000 initial cash outlay. Right, with a risk-reward setup like that, I know that their conviction is high. I would never take that trade unless I was sure, the way that paper has their trade set up here. So as long as the stock stays above 1050, the spread will expire at full value, which would be $2, and the trader would profit the difference, $2 minus that 30 cents, $3.4 million in weekly options in Groupon. Yes, they made their millions on this one. So here we have another example of how these trades come across in BBY. We saw a trader buy 16,000 of the BBY SEP 32-34 call spreads to sell the SEP 28 puts for a 50-cent debit. So they paid 50 cents for this trade. 16,000 times. We saw them first trim a piece of their position and take exit at $2.35. And again, this is one that I love to see because it has that short put component. I know that when they sell those puts to finance the purchase of those call spreads, it raises their conviction and therefore raises my conviction on this trade, right? They netted 370% profits in a matter of about a week here, $2.96 million. We see here how this set up here in Groupon on a chart. This arrow here indicates the day that they did this trade, and as long as the stock stayed in this area, the trade was going to be profitable, and it was. And the same thing for BBY here. We see they actually did this trade before the stock gapped higher and went into this profit zone. So this trade really led this move in the stock in Best Buy. And that trade actually even ran for even more. So is it really as easy as it seems? Oh, and I know, guys, I know this is a lot of information, so if you have any questions whatsoever, please don't hesitate to just ask. So is this really as easy as it seems? Unfortunately, the answer is no. I can't just come in here, watch the tape, wait for that one huge lot to hit the tape every day, and follow that trade. There's 2,000 trades that hit the tape every day, even when we filter out all of the noise. And out of those 2,000, there might be 3 to 5 trades that we will look at and actually take in our trading room. Like Fausto said, we trade our own money in real time. And out of these 2,000 that hit the tape every day, there might only be 5 that I'm willing to risk my capital on. With that much volume on a trade, do they have inside information? Most likely. Not necessarily. Sometimes that definitely is the case. A lot of people get chopped up trying to follow unusual option activity, speculating on buyouts or mergers and acquisitions, and that doesn't always work. Ahead of big deals, you can go back and you will see some unusual trades usually. But if they do have insider information, as soon as that trade hits the tape, that is public information. The trade hitting the tape is public information. So if I'm following their trade, there's nothing wrong with that. So the trick to unusual option activity, and what actually makes it more difficult than it might seem, is the fact that paper usually has some kind of underlying stock position. And that is why calls are not always bullish. They can be bought as a hedge against a short stock position, and puts are not always bearish. They can be bought as a hedge against a long stock position. No, the scanners are not like an options calculator. The scanner is a real-time feed of all trades that take place on all equity options exchanges in the United States. Right, so all day long, we looked at that LUX order. All day long, I see those hitting the tape, hitting the screen in a big feed, and I look for the ones that actually provide me some information that I can then arrive at an actionable trade idea. So what we actually see a lot of times, and we saw this yesterday actually in a stock, we have big blocks of calls that are bought. Yesterday we saw a trade in the XLK with the technology ETF, and this is again ahead of Apple's event today. We saw a paper come in and buy 25,000 of the September 27th. Those are the weeklies, the ones that expire on Friday the 27th. 33 calls for between 5 and 6 cents. With the stock trading near 31. So that was an extremely, extremely bullish looking trade, right? However, when they come in buy calls for 5 cents, odds are that's not paper trying to get long the stock. That could be paper trying to cover their short units in the XLK. That could be paper trying to cover short units in Apple or Google or any other technology stock, individual stock. Right? So that's what we need to decipher. Right? That's our end goal. And I'm going to talk a little bit about what stocks and what products trade best on unusual option activity and which ones you might want to avoid. And this XLK trade from yesterday is a perfect example of one that I would want to avoid. So how do we get to the end where we decide what our actionable trade idea is, or if this information is useful to us? Every day in our trading room, Andrew and myself go over an easy 7-step trading plan for all of the unusual option activity I see. There's a lot of trades that are winners that I end up not being in, but traders in the room have ended up taking. There isn't a blanket statement that I can give you guys that'll say, well, this is how you need to trade unusual option activity every time, because everyone is different. Everyone's risk tolerances are different, and everyone's risk appetite is different, right? I can't chase every trade. The trading plan keeps me from doing this. So I look at the best trades possible. Andrew currently has well over 50 positions in his book, and I carry 25 to 30 at any given time. And we also have a similar trading strategy for trading earnings. But the earnings, the unusual option activity trading plan guides me away from closing positions, guides me away from positions that are most likely hedges against the paper's underlying stock position, and kind of gets me into the best setups. We believe it's a really good way to set up unusual option activity trades and use this information in the most effective and efficient way. So there are definitely types of order flow that I want to avoid. Order flow that I will not take a trade with, no matter how big the block is, no matter how big the order is. I'm just not going to pay attention to it. Number one is definitely any closing position, right? I don't want to be entering a position as paper is exiting a position. As the institutional trader is exiting his position, why would I want to be getting in? That's not the time for me to get in. Two is big ETFs. And the XLK trade from yesterday is a very good example of this. Why don't I want to be trading big ETFs? Now, I've said multiple times throughout this presentation that my main goal is to decipher what paper's underlying stock position is. When I see a big block trade in an ETF, sector ETF, market ETF, index ETF, it is impossible for me to truly decipher what paper's underlying position is there, right? There's no way I can do it. Calls and puts in the SPY can be traded against baskets of other stocks. They can be traded against individual stocks. Calls and puts in the XLK can be traded against a trader's Apple position, can be traded against his Google position, can be traded against his HPQ position. Big blocks of calls and puts in the VIX can be hedges against overall portfolios of stocks, long portfolios, short portfolios. Every month, there's huge block trades in the VIX that institutional players take as a hedge against credit default swap portfolios that they hold. Right? It's impossible for me to decipher what the underlying position is by looking at trades in big ETFs and indexes. Can't do it. So that's a ton of trades that hit the tape every day that I can immediately throw out and consider noise. There's no useful information in those for me. We see it all the time. In the VIX, right after the fiscal cliff situation was resolved at the beginning of the year, we saw huge, huge blocks of upside calls being bought in the VIX. 200,000, 100,000, 250,000 contract blocks. Huge, huge bets, tens of millions of dollars. And of course, when that happens, we have a lot of our financial media pundits saying that, wow, someone out there knows that the market is going to crash. Someone knows that something bad is coming. What happened to all of that money? All of those options expired worthless. And then they came in the next month and did it again. Not because they were speculating, but because that was a hedge. Those were all hedges. And if I follow trades like that, I'm throwing my money away. So I want to look at opening positions versus small original open interest that are large multiples of usual volume. 100,000 lot in the XPX is not interesting to me because hundreds of thousands of contracts trade in that every single day. When 10,000 puts are sold in LUX and only 100 options trade on average, that is what I want to look at. That is the best type of unusual option activity, and you often see it in weird or uncommon stocks. And why do weird or uncommon stocks work best? Because they can't use those options to hedge against a position in something else. Right, and I know I'm saying the word paper a lot. I think someone had missed the beginning. Paper is a term we use to talk about institutional order flow. When they used to trade on the floor, orders would come in on actual pieces of paper, and that's where the term. It's a holdover from the trading floor. Right, and I only want to trade opening positions. Okay. So there are over 8,700 stocks and 3,200 stocks with options. Using unusual option activity this year, we've been able to take profits of 1,000% in Clearwire, Sprint, TMUS on unusual options activity alone. Oftentimes we'll see trades that are 25%, 50%, 100% profit just by following the trades that institutions are doing. Today, First Energy, FE, they came in and bought 8,000 out of the money calls for 23 cents. Today, there was a point where those calls were trading at 35 cents. So huge profits in just a single day in those, right? And we're able to pick those out because it comes up as a multiple over usual volume. One of the most common questions I get is how do you find stocks to trade? What are the best stocks to trade? And my answer is always, if I'm not following some kind of plan or using some type of information that other people might not have or might not understand, then I'm just guessing. So we say using unusual option activity helps me stop guessing and start trading, following institutional order flow. It has me trading the exact same positions that are being executed by hedge funds, mutual funds, pension funds, the big money, following big money into the trades, but always defining my risk versus reward setup. This is a huge, huge part of our unusual option activity trading plan. Like I said earlier, paper selling puts is one of my favorite types of unusual option activity because they usually do not have an underlying stock position. However, selling puts naked is one of my least favorite types of trades. I never do it. I never sell puts naked. Why? Because there is a huge amount of risk involved in that. So the trading plan helps guide me into a trade strategy or a trading setup that doesn't have that huge risk attached to it, but still takes the same directional view as paper. Spreads, advanced order strategies. Remember, I never want to have a single trade with the risk of blowing out my entire account. We call that blowout risk, and I never want to have any trade that has that type of risk. And using these types of strategies, avoiding tweaking paper trades to have a better reward to risk setup, we have had over 60% returns year to date. And we have a spreadsheet with all of the positions online. We update it twice a day, and all of the trades are listed as a percentage of total book. Right? This is the best way for us to measure risk. And it's the best way for me to set up trades that are to size my trades as well. That's another very common question I get is how do you size trades? And the answer to that is I always look at it as a percentage of my growth. How much can I lose on this trade? So here we have the other types of unusual option activity that our scanner is able to provide us. Number one here and at the top is multiples over normal volume. That is the one that we pay the most attention to, yeah? So when a trade hits the tape, if it's not a multiple over normal volume, and the volume that it uses is the 22-day average equity option volume. So we can see here we have a list of stocks that came in on the unusual option activity scan, Dell, APC, AEO, GES, and next to them we have this multiplier. 5.7 times usual volume, 2.3 times, 6.3 times. You know, and I, in general, will want to look at the ones that have the highest multiple over usual volume, right? Because that would be what the activity we would consider to be the most unusual. I always want to know that trades like this have large impact on delta and implied volatility. Although I tend to avoid trades in big indexes like the VIX, the SPX, big trades in ETFs, sector ETFs like the XLF, XLK, ETFs like the SPY, the Qs, or the diamonds. I do sometimes want to look at top trades in terms of size. So what is the biggest block of contracts that has traded in a single day? Right, because that can sometimes give me some type of actionable information. Large changes in implied volatility. You know, which stocks today have had the So someone asked, if I don't sell open puts because it is too risky, can't I use a covered call position to get the same risk profile? And the answer is yes, I could. But because it has the exact same risk profile, I wouldn't want to be doing it. Instead, I might look at selling put spreads, selling put verticals, selling iron condors or iron butterflies, or buying call spreads. All of those trades have a capped risk and capped reward profile that is well defined from the onset of the trade. A covered call is the same thing as a short put, synthetic short put. And that has that same amount of risk attached to it as the naked short put. So I wouldn't want to be doing that. So yeah, large changes in implied volatility. Why in a given day would a stock have a huge swing higher or lower in implied volatility? Does that create opportunity for me? Richness and cheapness of volatility is also something that I look at. And I also like to look at that ahead of a catalyst event, right? Richness, where are options looking expensive? Do I want to be premium long or premium short? And I can't just look at that and automatically decide, but it does kind of frame my mind as to what I might want to be looking at. Large put-call ratios. In general, are option holders bearish or are they bullish? And we have a lot more examples of statistics like this. You know, we see all the time, you can find a statistic on a statistic and backtest any strategy to become profitable, but using multiples over normal volume as our #1 indicator is something that does work. And the reason that it works is because that has actual money behind it. It has institutional money behind it. Right? Unlike any other technical indicator, you know, technical indicators can't say that. So that's pretty much all that we have here on for our presentation. We do have a class coming up on September 18th, and there is a link included here. It is limited space. It is an extended version of this presentation with a 2-hour-long class, how to read unusual options activity, and an in-depth look at our unusual option activity trading plan. we're running a special for participants of this webinar. Can sign up for this class for $47. That is a good value. It's a regular retail value of $97. The class will be taught by Andrew Keene, and he will talk about how he earned $7 million in a decade trading and using unusual option activity, how to follow hedge funders' positions, and how to pick out stocks using a systematic and methodical trading plan. Stop guessing and start making trades, and how to learning how to use a confidence scale to avoid blowing out your account, and how to properly size trades. Like I said, there's a link included here, or you can contact us at this phone number, 312-261-5581, or email John at Keene in the Market with any at KeeneOnTheMarket.com with any questions about this presentation, about the class, or anything else it is that we do here at Keene on the Market. So if there are any other questions here, I can answer them now. Can I find these orders on Thinkorswim or the Trade Monster platforms? And the answer to that is no. I'm not going to be able to see the depth of order flow using those platforms that I am with the scanner. So some people telling me that the link isn't working for them, so I'm going to go ahead and put it in the chat box here. So some more questions here. What is our average time in a position? Well, that all depends on the trade that paper is doing, yeah? So if paper is coming in and buying calls in the weeklies, and I think that that is an interesting looking trade, and I think that it's a bullish looking setup, then my time frame is going to be the same as papers. Remember, timing in options is almost as important as direction, right? Do we have a service that helps with trades without being at the computer all day? Yes, we do offer a premium Twitter service and a text alert service that traders can access via any mobile device. For more information on those or any of the other services we offer, you can contact this phone number here or email John at Keene on the Market. Do I restrict my trades searches to particular price or volatility range? Okay, so the scanners that I have are set to a contract size threshold, right? So for one, I want any trade under 100 lot taken out, and the scanner works for and picks up mostly on trades that are multiples over usual volume. Technical tools that we use to filter trade, yes, that will be covered in the seminar. We'll talk about our 7-step trading plan. Neither Andrew or myself are big technical analysis traders, but there is a technical analysis component to the unusual option activity trading plan, one that we think works very well and is very simple to use, especially for traders who might not be, very adept at technical analysis. So the class, like we said, is going to be 2 hours long. Traders will learn how to read unusual option activity. You know, I talked a lot about it here, but you know, there's a lot more minutia and detail that goes into this, and also we'll go over our unusual option activity trading plan. This is how I get from step one, which is seeing a trade hit the tape, to the final step, which is taking my money and putting in a trade on. Right, and we're going to talk about that, how we filter out all of the noise, and how we get into the best trade setups. Can paper hide their large trades by submitting multiple small lot sizes? Yes, they can. But they almost always get caught, right? I mean, if I see, you know, it'll still come up as being unusual volume, right? It'll still be a multiple over usual volume. You know, if I see one 5,000 lot hitting the tape, or 150 lots that are all labeled opening positions, you know, it's pretty much telling me the same thing, right? And we're able to see that. We're able to see that right away. As soon as that stock has option volume above its average daily volume, we know about it, and we're then able to take a look at the feed and the trades that have hit the tape that day, and are able to figure out, even if they do break it up into small lots, we're still able to find it. Yes, the course will be available in recorded form. So if the 18th isn't a day that you can physically be in front of the computer, you can still sign up for the class and catch it on a recorded form later on. Use one? Yeah. And anyone who does sign up for the class also gets a copy of the slides for their own use. No, I generally want to get into the trade as soon as possible. Sometimes it's so fast I miss it, right? I can see a huge block of calls being bought for a quarter, and if I'm not quick enough, you know, I go to put the trade on and they're already bid at 30 cents, and it just takes off. I want to do it as soon as I possibly can. Uh, you know, I know that when a giant block trades, if that represents by itself a multiple over usual volume, I know I can go ahead and pull the trigger. So unless anyone has any other questions, not necessarily. Right. I can never fully know if it's against stock, right? The whole point of the trading plan is to figure out what paper's underlying stock position is. Right. And that's something that we're going to cover in the class. You know, I never want to wait to try and put the trade on, right? Because if unusual option activity leads moves in the stock, if paper buys puts and that leads will move lower, if I wait, I'm going to have to pay more. What options do I use once I see paper place a trade? I generally want to be trading in the same expiration as them. So that's for one. Two, I often will be taking the exact same contract as them, But if it doesn't set up on a good risk versus reward basis, like I talked about selling puts as being a very risky way to take a bullish view on a stock, I will then come in and look at maybe selling put spreads, buying call spreads. But I can always tweak papers trade to better fit my risk tolerances and my risk appetite. The class will be at 8 o'clock Eastern time, I believe. Let me double check on that right now. Yeah, so 8 o'clock Eastern, 7 Central on the 18th is the date of the class. Sometimes they are matched, right? But that comes across labeled as a spread, a risk reversal. They're selling puts and buying calls, right? But a lot of times, like, in LUX, we see that big 10,000 lot of puts being sold on the bid. We go ahead and take a look at LUX in the options chain, and open interest across all lines, across all expirations it was extremely low. No other options had traded in the stock that day, right? So that's a really, really telling trade. That's a very good piece of information for me to have there. Right. So if there are any more questions, right, and this is something that is especially valuable for retail traders, right, because it gives them access, kind of a roundabout way, to access information and technology that they don't have and could not get. Right. So unless there are any other questions, I think yes, users do get access to the scanner, and it is up and live in the trading room all day long. That would depend on the trade, and it depends on the stock too. It also depends on the strategy. For advanced strategies with multiple legs, like butterflies or condors, I might need to hold on to it a little bit longer before I take profits, because my commissions are extremely high in a spread with 4 options. What is the cost for our service? We have multiple packages and bundles. For pricing information, you can call the number on the slide here or email John at KeeneOnTheMarket.com. So any other questions? Any questions? Yes, the seminar, if you sign up for the seminar, it will be recorded and you will have access to it later. Oh, this seminar, this webinar is what you're referring to. Yes, it is. It is going to be available for viewing later. This webinar is recorded. In addition to, yes, the seminar that we are offering for the 18th was also going to be recorded. And people who sign up for the seminar will get a copy of the slides sent to them as well. For traders who aren't necessarily comfortable with options or with the leverage that options provide, or maybe they just don't understand options or cannot trade options based on the type of account they have, unusual option activity is also something that we use to set up swing trades in stock. Yes, all of the alerts we provide provide the trade exactly as we take it, and all of our entries and exits. How does so as far as percentage win rate goes, that's not actually something that we keep track of. A lot of alert service will tout their 90% win rate. And I can write you a strategy right now in any stock, any product that'll have a 90% win rate. But that 10% of the time that it doesn't win, it's going to blow out your entire account. Like I said, Andrew's book is up over 60% year to date. So we like to look at profits, not win rate. Options on bigger stocks prior to earnings. Yes, I would say our bread and butter is unusual option activity, and right behind that is trading earnings. We have a 9-step earnings trading plan that we go over every day in the room as well. Do I talk about the set of tools you use and platform for trading? Yes, we definitely do. I talk about that all the time. We have a retail audience, and because of that, I'm pretty familiar with every retail platform and talk about the different tools that they have. Andrew and myself both also do day trading in futures, single equities, and Forex. Average percentage return. Like I said, the entire portfolio is up over 60% year to date. We don't keep detailed records on specifically the different trading plans and their return rates because we take a very, very large amount of trades. I would say 5 to 10 trades a day, every day. Fast movers, Netflix, Google. I don't necessarily trade very many options as a day trade. Obviously, a lot of times unusual option activity will get me into a trade where an option will go up 50% in a day, and then I'll get out of a piece of it, or at any whatever predetermined level that I had in there. But yeah, we do look at setups in Netflix, Google, Mastercard, LinkedIn, any big stocks. Andrew and myself have both been day trading Tesla a lot lately because it has been moving well. We go over technical setups for day trades. Our main one is the Ichimoku Cloud. All right, so it seems like that might be Questions are starting to slow down a little bit here, so any questions about services that we offer can be directed to this phone number, or an email can be sent to John@Keene on the Market. Or if you want to email me, please do. Thank you again to Fausto and Cyber Trading University for allowing us to do this presentation today, and for having us here to talk to you guys.